All right, the closing bell has rung. Thursday, January 8th is officially in the books. And if you're just glancing at the top line, well, the market looks deceptively calm.
Deceptive is the right word. Because under the hood, the internals tell a story of extreme capital flight and really some aggressive rotation.
Let's hit the scoreboard immediately. Stark divergence is the theme.
Absolutely.
The S&P 500, it managed to finish up a modest, almost non-committal, plus 0.22%. A technical win, but just barely.
Right.
But then you look at the Nasdaq 100. It slipped pretty significantly, closing the session down a full 0.5%.
Down 0.50%.
Meanwhile, the Dow, with its heavier industrial weighting, it actually outperformed. Closed in the green, up 0.18%. So what do these fractured internals tell you about conviction right now?
It signals a market that's just deeply conflicted. I'd call it a choppy mess. We saw zero, and I mean zero, follow through from yesterday's late day bid.
So we're trapped.
We are trapped in a high-volume node. Institutional desks are just in a holding pattern. They're weighing cooling inflation against what still looks like a pretty stagnant labor market. And that uncertainty is why the money is rotating, not buying the whole tape.
That rotation, that brings us to the main story of the day, right? The defense and AI tug of war.
It really was. This wasn't minor.
No, this was an all-out institutional switch.
It was aggressive and it was binary. You had two massive opposing forces. On one side, you get the announcement of that proposed, a $1.5 trillion defense budget.
A huge number.
And it immediately catalyzed huge block buying. It sent aerospace, government contractors, think LMT, NOC, it sent them to the moon. That's tangible, guaranteed cash flow.
And then countering that, you had the big reversal in, what was the dominant theme? The AI trade.
It paused. Or maybe a better way to put it is it suffered heavy distribution.
Distribution is the word.
Precisely. All those valuation concerns, how much growth is already priced in. It hit the semis, it hit the software heavyweights hard. And that's why the Nasdaq sold off, even while the S&P kind of ground higher on the back of defense and energy.
A rotation out of perceived growth risk.
And right into perceived geopolitical safety.
You can see it so clearly in the sector highlights. Energy, XLE, led the charge. Up a decisive 1.4% on renewed supply-side jitters that hit the wires mid-morning.
That's a classic flight to defensives. It's a hedge.
Exactly. A hedge against the very tensions implied by a massive defense budget. Yeah. And on the other side of that coin,
you saw the pressure on anything tied to a bullish consumer. Consumer discretionary, XLY, was the clear laggard, dropped almost a full %.
And that was triggered by some specific guidance, right?
Yeah. Cautious post-holiday guidance from the big box retailers. That just signals to the smart money that the consumer isn't sprinting into Q1. It validates the lower growth expectation.
Okay, so we know where the money moved, but let's talk about the quality of that movement. We need to get into the internals, because this was textbook capital rotation, not a rising tide.
Exactly. If you just looked at the aggregate numbers, you would be fooled. Broad market volume was actually soft. It was about 15% below the 20-day moving average.
Looked like a quiet day.
Right, a low conviction day for the market as a whole. But the devil is always in the details.
And when you drill down, that's where you find the high conviction volume confirmation. Those defense stocks we mentioned, Lockheed, Raytheon, Northrop.
The volume surges were shocking, 400% to 500% above their 50-day averages.
You do not get moves like that from retail.
No, that is the footprint of institutional money making a high-conviction bet. It was large desks executing massive switches, redeploying capital. So the verdict is institutions largely faded the midday rally.
Okay, but I have to challenge you on that a little bit. If they were fading, how did the S&P still hit an all-time intraday high? It touched 6,973.75 this afternoon.
That is a crucial observation, and it highlights the danger. Yes, the index hit a high, but if you were watching level 2, watching the tape, buy pressure began to visibly evaporate right around 3:55 p.m. Eastern.
So that high was just algorithms and passive flows.
The last of it, exactly. The professional money is absolutely derisking, and the reason is simple. Tomorrow's non-farm payrolls, NFP.
The elephant in the room.
It is. The risk here is asymmetric. The whisper number for jobs is already low, maybe 45K. Institutions are just not willing to hold those high-flying AI positions into a potentially weak labor print. They took profits at that 6,973 high and ran.
You can see that flight in the breadth numbers.
Yeah.
The rally was, let's call it fragile green. The advanced decline ratio closed at a really weak 1.2 to 1 on the NYSE.
Only 55% of stocks moved higher. I mean, when the S&P closes green but barely more than half the stocks are participating, that is the definition of concentration risk.
And that weak participation leads us right to the classic warning sign we always highlight.
The negative divergence.
Right. The S&P is testing all-time highs, but the cumulative advanced decline line failed to make a higher high. So for the trader listening, why does that specific failure matter so much?
Okay, think of the S&P as a sports car, but only 2 of the 8 cylinders are firing. The cumulative AD line measures the health of the entire engine.
So the engine is sputtering.
Exactly. When the price makes a new high but the AD line doesn't confirm it, it means the average stock is leaking capital. It tells you the rally is running on fumes, and it's susceptible to a violent correction on any bad news.
Great analogy. Okay, let's shift to the key reversals. Today was defined by some violent intraday flips.
It was. Starting with the fades, the Nasdaq 100 closing near its lows. But the clearest technical signal of the day was in commodities.
Let's talk about silver. It had been on a tear.
Absolutely parabolic. After flirting with record highs, nearly $84, it printed a massive, picture-perfect, bearish engulfing candle.
Oof, down almost 4%.
Down 3.76% to $78.19. This is a classic blow-off top signal. For anyone listening, just picture it. Silver opens strong, makes a near high, then sellers come in and not only erase all of today's gains, but drive the price to close below yesterday's floor.
A complete and violent rejection.
Total rejection. The momentum chasers are now completely washed out.
And you saw the complete opposite in the defense complex. Those stocks gapped down at the open and then just reversed violently.
Right. LMT, NOC, RTX, they all closed between 4% and 8% higher on that budget news. That swing from the low to the high is the confirmation of that high conviction notation we were talking about.
And we should mention one tech name that bucked the trend. Palo Alto Networks.
PanW, yeah. It bounced aggressively from deeply oversold levels, specifically on some M&A speculation that hit the tape. It showed real relative strength into the close.
So even with tech selling off, money is still hunting.
Hunting for asymmetric, deep value plays. Exactly.
Okay, let's check the sentiment gauge. VIX settled at 14.85. On the surface, that looks low. Complacent.
And that's the trap. Don't mistake lack of movement for lack of risk. We're in what I call a low-vol, high-protection environment.
Meaning?
Well, we saw some minor IV crush in the front-end weeklies because today was quiet. But the back-month skew is still bid up. Professional money is paying a premium for options protecting against future risk, especially with earnings season coming up. They are not complacent, they are hedged.
All right, let's pivot to tomorrow, Friday. The market is coiling, and NFP is the trigger. You called this a volatility squeeze.
It's the ultimate squeeze, like a toothpaste tube pattern. Realized vol is dropping faster than implied vol. The spring is getting wound tighter and tighter. Tomorrow's jobs data is the hand that's going to force a violent break.
So given that expectation, let's talk about the critical level. What's the line in the sand that every institutional desk is watching tonight?
That line is 5,950 on the S&P 500. That is the current zero gamma flip zone. And if you are an active trader, understanding this level dictates everything for the next 24 hours.
Okay, so explain that. What does zero gamma mean for dealer behavior? Why is it so important?
It creates a really clear asymmetry. So when we are above 5,950, dealers are long gamma. That means they are a force for stability. They sell into rips. They buy dips. That's what gives you that boring sideways grind.
But the danger lies just below it.
Absolutely. If we lose 5,950, the trapdoor opens. Dealers flip short gamma. Now, when the market moves down, they're forced to sell futures to hedge their books.
Which accelerates the move down.
It turns into a self-fulfilling cascade. It turns the hedging desk into a momentum desk, amplifying the selling pressure.
Okay, so with that setup, betting on a violent break, but the direction is a coin toss because of NFP. What's a textbook trade here?
This setup just screams long straddle or a long strangle. You're betting on volatility, not direction. We're looking for a move of 1.2% or more in either direction by Friday's close. Don't pick a side, pick the expansion.
That makes perfect sense. The probability of another quiet day is extremely low when NFP hits the wires.
Right. We expect a high-volume trend day. 5,950 is the governor that determines whether that trend is a controlled grind or a panic flush.
Okay, let's finish with specific day 2 plays. Asymmetric risk-reward for tomorrow's open. Let's start with a long setup.
For the long, I'm looking at relative strength. That's NVDA. NVDA, it closed strong, top of its range. Even as the Nasdaq was getting hammered, we saw institutional accumulation all day. It has decisively cleared that $145 overhead supply.
So what's the actionable trade?
You look for a long day 2 play on a retest of that $145 level. If it holds, that's your new support. The short-term target is $152. You're betting that money rotating out of broad tech will concentrate into the highest quality names.
All right, on the short side, you highlighted Palantir, PLTR. That late-day rejection on a big volume spike looks suspicious.
It's a classic liquidity trap being set. You had professional profit-taking meeting aggressive retail buying on rumors. Those day one buyers are about to get squeezed.
So the short setup is aggressive.
Very short. If PLTR loses today's VWAP, the volume-weighted average price, at $72.40, that's the key level.
And if that level fails,
If it breaks below that, those day one buyers who anchor to that price will panic and liquidate. That targets a fast flush down to $68. It's the classic liquidity trap trade.
clear lines in the sand on both sides. So the directive for everyone listening, keep position sizes tight until that 5,950 level is decisively claimed or lost. That is the line heading into NFP.
And keep one eye glued to the VIX. A drop below 1400 tomorrow triggers the melt-up algorithm. If VIX crushes that low, market makers are forced to buy Delta no matter the headline. That's your confirmation signal for a rally.
The ultimate green light. So as we close the book on Thursday, what's the takeaway? Massive rotation, fragile divergence, a market coiled tight.
The surface looks calm, but the engine room is overheating. We have zero breadth, negative divergence, and a tight volatility coil ready to break. Prepare for a battle tomorrow between mean reversion and range expansion. Stay sharp.
Great analysis. And that's your deep dive institutional brief for the Thursday close. We'll see you at the open.